Hardik, thank you so much for joining us today. So, as the group now knows that you're a leader with over a decade of experience in the ESG, sustainability, and investment space. So, we're really looking forward to know more from you on breaking down career paths and what it takes to really be successful in the climate finance and investment space. So, over to you, and as you'd like to run it. Thanks.
Sure. Thanks, Sombul and Deshna, and hello, everyone. Good evening. So what I've done is I've kind of created maybe about 8 or 10 slides just to build the context around uh, why should be worried about climate finance, or why should we pay more attention to climate finance and climate investing? And these are slightly different things. So I'll try to bring in the nuances there, and then towards the latter half of this kind of session is basically an open discussion, right? So I can share some of my thoughts around what kind of career opportunities exist in this space, whether it's banking, whether it's asset management and consulting. I think you would heard from Jocelyn before, so I'll probably not go too much deep into that. But just kind of a big picture, what kind of career opportunities exist, and then also in terms of capacity building and skill development. So I'll probably spend about 10-15 minutes maybe just to build the case around climate finance and investing, what kind of instruments are out there. Yeah, so I'm kind of going to cover basically why is it necessary, and then what kind of instruments or approaches exist in the world of finance, which are being implemented to various degrees, right? So let's kind of dive into that. I think the first kind of obvious question everybody should be asking is like, why are we worried about, uh, say, global warming or carbon emissions and so on? The chart on your right is probably the most important chart that you should be paying more and more attention to. This is basically showing the level of carbon dioxide in the atmosphere over the last 800,000 years, right? And what you see on the far right is basically where we are today. Uh, no, yes, I think it hasn't been stable. It kind of varies between, let's say, 200 to 300 parts per million in terms of concentration in the atmosphere. But where we are today is basically unprecedented levels. This is what worries scientists. This is what worries environmentalists, and this is what should worry you as well. Uh, why is this important? Because Earth, at least as we know it, hasn't been in this kind of an environment before. So we don't know how Mother Earth will react to this particular kind of temperature or this particular level of concentration of carbon emissions, and hence we are worried about, let's say, unpredictable risks, right? So what in the world of finance, what people always worry the most about is things you can't measure, things you can't forecast. I know it's difficult to forecast to the T, but uh, at least you should have a rough sense of where things are going. In this case, we are basically shooting in the dark, if you may, right? Um, because of this, what the IPCC, the Intergovernmental Panel on Climate Change, is essentially predicting is the world is going to be more than 1.5 degrees Celsius warmer compared to pre-industrial era, probably passing 2 degrees Celsius as well. There are a few more reports coming in the recent years. So this is definitely something that should worry you. Now, this illustration I pulled out from something called as the TCFD, the Task Force for Climate-Related Financial Disclosures. This basically links these say physical and transition climate risks to a financial impact, right? So now the question is, okay, yes, world is warming. Why should I care as a finance professional? This is why you should care. Let's talk about transition risk first. Transition risk is essentially risk that will arise out of either policy changes or technology changes or some sort of customer preference changes which are driven by climate change, right? So let's say, for example, because you and I are facing much more warmer weather year on year, and you and I are probably more concerned about climate changing, we'll say, okay, where should I be buying my next product from, whether it's an iPhone to a car to maybe even a house for that matter. Is that particular company more aware about climate, and is it factoring in, let's say, more sustainable practices while building that product? Those kind of things. So that kind of points to the change in customer preferences or market kind of perceptions. On the technology side, you're already seeing electric vehicles, whether it's two-wheelers or four-wheelers, kind of come in a big way, even in the India market. That's just changing significantly uh, the paradigm of the automotive industry, right? I'll give you just one quick example, and I'm myself a EV owner, EV car owner. The running cost of a electric car is probably 80% lower like to like compared to an internal combustion engine. So there might be some, let's say, marginal upfront capex that I do more while buying the EV, but the running cost is significantly lower. So you don't have to be, let's say, an environmentalist or a tree hugger to actually say I need to go with the EV. Now it's kind of making commercial sense. And similarly, use the same examples, whether it's renewable energy versus coal-based power generation. There's a lot of kind of economics are now pointing towards renewable being the more preferred kind of technology, right? So those kind of things. And then obviously on the policy and legal side, you're talking about carbon emission capping and of some form, whether it's carbon taxation, whether it's um, some sort of a emission allowance kind of a scheme. And in India, I think later this year, you'll see it starting to be implemented, what is known as a CCTS or the carbon credit trading scheme. So there is essentially, this is not something I remember when I started in this space back in 2010. We were thinking of this as a bigger issue for the next generation. This is actually impacting you and me today, and we are not prepared, right? So essentially these risks, and obviously physical risks, I don't need to go too much into detail about, like the erratic weather patterns you and I are seeing year on year, whether it's floods, droughts, wildfires. This is just increasing both in terms of frequency and magnitude. So hence all of these things are impacting a company's ability to generate steady and sustainable cash flows, profits. And hence, as an investor or as a banker who's lending to these companies, we should be worried about, am I kind of factoring in the climate risk that this particular business or this particular project is facing sufficiently well? If not, then basically you're exposing yourself to some sort of risk, whether it's uh, reduction in valuation for a particular company, whether it's basically a credit risk or a default risk for a particular loan or a bond issuance. It comes on different ways. I think it would be unfair to just talk about risks here, and I'll maybe spend a minute on the opportunity side as well. Whenever you see any problem emerging, anybody who comes with a good set of solutions for that problem, they'll be much more in demand. Now, let's take a very day-to-day example, your uh, quick service kind of uh, Zeptos and Blinkits of the world, right? I mean, it's making things so convenient that you and I are basically saying, okay, I want a toothbrush, let's just Zepto it or Blinkit it, whatever it is, comes to my home in 10 minutes. That's really easy. I don't have to go to the nearby grocery store, probably spend half an hour in the traffic going to and fro. I can just do it this pretty easily. So similarly, on the climate side, businesses which are providing products and services which kind of either help mitigate climate change, so things like renewable energy solutions, energy efficiency, and so on, or help you adapt to climate change. And I think adaptation is a piece that is uh, for various reasons less focused in the industry, and I think we should be focusing more and more on that, but I'll come to that in a bit. These businesses will see more uh, consistent and growing demand for their products and services as basically uh, things play out, right? So hence there's also an opportunity as an investor into these, let's say, if you're an equity investor, for example, to kind of invest in these companies who are not only growing their revenues and profits, but also kind of having some sort of a positive environmental impact. So for both these reasons, you see both investors as well as bankers trying to kind of pay more and more attention to environmental issues, but more specifically climate as a topic. I'll not bore you with the text on the left. I think on the chart on the right is something that is probably worth paying a little bit attention to. A lot of investors are starting to do what is known as climate scenario analysis. Now, essentially, I mean, if you're a student of finance, you would know scenario analysis is common practice when you do any sort of forecasting, because you don't know what exactly is going to happen. If you know, then yeah, you'll probably be very, very rich. But in the absence of certainty, you basically try and model various scenarios to see how your particular investment will react or how certain risks will play out. Uh, uh, when people do climate scenario analysis, what they're essentially saying is whether the world continues to operate as it is today, and let's say we get more and more carbon emissions in the atmosphere, and we get more and more global warming, and hence ill effects of global warming, or suddenly governments and companies wake up and start acting faster to reduce or decarbonize their businesses and economies. And hence we have more a policy and a transition kind of risk emerging, right? So on the right, what you see, if you do aggressive mitigation efforts, you'll definitely limit global warming and hence lesser physical climate risks, but more transition risks. On the left hand side, what you see is you don't have carbon regulations, you don't have enough and speedy enough efforts to reduce carbon emissions, and hence you'll have more physical climate risk but lower transition risk. So this is like you have to kind of find a way. Okay, what you according to you will be the right pathway the world and maybe certain economies will follow. And based on that, the impact on your companies will be different, right? So let's just take a one quick example to understand this better. An oil and gas exploration, or let's say an oil and gas refining company, let's say um, ONGC or even BPCL or IOCL, these guys will be impacted very differently in a world which is on the in a scenario which is more on the left hand side. Meaning, let's say carbon policies and carbon decarbonization efforts are slower, meaning their products which are more fossil fuel driven will continue to kind of being used, and hence they will continue to make money, or let's say grow their businesses for the foreseeable future, versus if there are more and more carbon regulations, meaning we'll use more renewable sources of energy versus conventional fossil fuel base. And in that scenario, their businesses will actually be impacted, right? The growth of their businesses itself. So depending on which scenario you model, the impact on the company will be very, very different. So these are like some of the exercises that investors and I think in some cases bankers also do to basically figure out what kind of or what degree of impact it could have in their portfolios, or as well as maybe whether it's lending portfolio or an equity portfolio. Um, uh, Here, what you see is essentially a spectrum. Now we're going from why should you be worried as a financier or an investor about climate risk to various kind of approaches. So this slide basically talks about uh, how in the investment space there is a variety of approaches, and then what kind of focuses these different approaches have. So I'll not go into every single thing, but on the left hand side of the spectrum, you have traditional philanthropy, right, where your goal is to address some sort of a societal challenge. So, and basically cause a positive impact to the society, whether it's education, healthcare, women empowerment, it could be a variety of different things. And the way you kind of achieve that goal is basically by using grants or donations, right? So donate money to certain NGOs who are taking efforts at the grassroots level. They'll kind of implement whatever objectives you have and give you a positive impact. On the right hand side of the spectrum is conventional financial investment, right? My job is as an investor is to just make the maximized returns for my clients, and obviously manage the risk as well. So that's, I don't care about anything else. I'm just purely focused on returns. So that's your conventional investing. In between this spectrum, you have different shades or different styles. The sustainable and responsible investing, the SRI, is essentially where you're saying I'm going to like focus on environmental and social issues to be able to factor those into my investment decisions rather than ignore them altogether. So I will not ignore a company who's very profitable but is actually polluting a river nearby. I will factor that risk in, maybe buffer in some sort of a penalty that they will eventually have to pay, and hence kind of reduce their expected returns and valuation and so on and so forth. So there are different approaches that people take. Uh, in the India market, what you're clearly seeing most asset managers do is what we know as ESG integration, meaning any kind of environmental or social risk, or even governance risk for that matter, which could have an material financial impact on the company. I'm going to focus on that. Everything else, I don't care, right? So they are basically taking an approach which is aligned to their role as a fiduciary, as a let's say a fiduciary of somebody else's money, right? People like you and me invest in mutual funds, either through SIPs or lump sum, and then the fund managers are the ones who are deploying that in different kind of businesses. So what essentially fund houses in India are largely doing is, given that environmental and social risk, and more specifically on the east side, I think climate risk is the biggest risk that not just Indian investors, but I think global investors are focusing on. Let me try and quantify the risk exposure for my portfolio. And if there are certain risks which are much more higher than my kind of liking, then either I should be paid sufficient returns for taking those risks, or I will manage my risk exposure to make it lower, right? So and maybe use engagement as a tool. So that's what most Indian asset managers are doing today as we speak. Um, When you go to the fixed income side, some of you might have heard of green bonds or like sustainable bonds. The next couple of slides just kind of lists down, and I'm happy to share this later on if you want for reference, so you don't need to note down everything. Uh, these next couple of slides talk about various type of bond instruments, which are essentially in kind of in the market, and what kind of use of proceeds they are targeting, right? So green bonds is something that is most commonly known. Essentially, what it does is it's a typical bond, but the use of proceeds, like when you raise the funds, where will the funds be deployed? That is going to be for a green project. Now, what does green mean? It will have different definitions and different jurisdictions. There's no single definition of green, meaning, okay, this is green, this is not green. Later on, I think I have one slide which talks about different shades of green as well. But depending on which country or which region you are raising funds and deploying funds in, you might have different taxonomies which allow what is green and not. Social bonds obviously have focus on social projects that have social impact, right? So whether it's affordable housing, microfinance, healthcare, and so on and so forth. Sustainability bonds is basically a term which is, I would say, a more umbrella term where you uh, uh, could have a environmental focus, social focus, or a combined ENS focus. So that's what sustainability bonds are. Sustainability linked bonds, and there's also an instrument called sustainability linked loans. Now these are I would say more newer instruments in the financial world, in the banking world, which are being used. What this essentially does is links your interest rate for the bond, right? As a borrower, you will be paying, let's say, 8%, 10%, whatever that interest rate is. It will link that interest rate to some sort of a sustainability factor. So if you are able to meet that particular criteria or exceed that criteria, let's say, for the sake of example, let's say carbon intensity, right? So lower is better. So if your carbon intensity is 100 tons of CO2 per $1 million of revenue, your interest rate is 8%. If it is below that, let's say 90 or 80, whatever that number is, you will probably get an interest rate of 7.5%. So that means you are incentivized to be a bit more carbon efficient. And on the flip side, if it becomes 110, then you'll probably have to pay an interest rate of 8.5 or 9%. So that's how roughly these instruments work. Uh, in a way, this is incentivizing companies to be a bit to have more sustainable corporate behavior. Um, Last couple of things I like to kind of focus on this slide is transition bonds. This is becoming more and more the flavor of the market. Green bonds was and still is, I think, a big chunk of the market. But in the last year or two, you're seeing global regulators, global central banks, as well as investors talk more about transition bonds. And the sole reason why that is really important is you can't basically fight climate change or fight global warming simply by investing in green projects. Yes, they have a part to play, but the existing economy, whether it's a steel sector or cement sector or utilities, decarbonizing that is very, very important. And that is not going to be possible simply by, let's say, putting more solar panels or wind farms, right? So the transition bonds are basically what they are trying to do is provide financing to these so-called brown industries to help them decarbonize faster because there are rather limited say financially viable options or scalable options for these guys to decarbonize. So this is in a way trying to support an industry which is not so-called green. So your investment won't look green on day one, but to kind of help them transition towards green. And this is very, very critical. I think the next other two I'll just skip it for the interest of time. You can read through later on. Um, I think this is probably my last slide, and then we go into the career space. There are different shades of green, like I said, depending on a region. Maybe let's say in China, for example, energy efficient, let's say coal-based power plants could also be classified under green projects, whereas in the European Union that's not allowed, right? So depending on where you're raising funds and deploying funds, investor expectations could be very different. And on this slide just talks about different shades of green as well as what is kind of considered brown per se. I'll just pause here to see if there are any questions on what I've spoken thus far. Otherwise, I can talk a little bit about my role and what I typically do on a day-to-day basis.
I think we can just check. Deshna, do you see any hands raised or if any? I think Ishita has a hand raised.
Yes, Ishita has a
Ishita,
hand.
please go ahead, Ishita. Yeah.
So, what kind of bonds exactly are more common in India? Like you explained a couple of bonds, and globally as well. Like which are giving the most amount of funding, maybe?
Green bonds. Yeah, green bonds are the more popular ones in India. And I think in India also they've been around for at least 5 years, probably if not more. That's the more common instrument that's been kind of used by banks.
Okay, thank you.
Yeah,
Hello.
yeah, Ashish.
I just want to ask, after the BRSR mandate by the SEBI, so why the transition bond has not increased in India? Companies this transition from the initial stage to final stage, and still the green bond is at a high peak. Why?
So I think it's just the maturity of the transition bond is still at an early days. I think if we talk in 2 years' time, you'll see more and more transition bonds kind of being the focus. It's just kind of this term has picked up attention only in the recent year or two. So it's just early days. That's the reason. But you're right. I think it should be not just green bonds, but also transition bonds should be the focus, especially for an emerging market like India.
Okay.
I think there are a few questions in the chat as well. I'm not sure if Dyuti you're able to unmute or not, but Dyuti has a question that there's also an increasing interest in blended finance. How has the response been for blended finance in India? Any thoughts on that?
Yeah. So I think broadly, we haven't discussed this in detail. So what blended finance essentially does is you provide some sort of maybe let me take a step back. Now, certain projects are just financially viable, right? So you don't need a special support to fund these projects. It's basically you know the cash flows are great, you know the return on investment is great, and you will have bankers lining up to basically fund those projects. There are other types of projects which might be in early kind of stages of development, let's say a pilot stage, or which might have let's say a worse return on investment than what the investor is expecting. And for these projects, what in the financial terms, what we call it are, let's say, non-bankable projects or difficult to get some sort of an investor in there. For those projects is where blended finance is coming in as a way out, where you have multilateral organizations, for example, like the World Bank or the IFC, taking in the first degree of risk, right? So what they say is, I'm going to provide concessional capital. I don't expect much returns, or I'm okay with basically getting very poor returns. I take the hit if the technology doesn't kind of ramp up as it's expected, or the project doesn't really deliver returns. And then other investors come in to essentially uh, fund the rest of the piece, right? So let's say if they need $1 billion, maybe the first 100 or 200 million comes in from one of these institutions like the World Bank. They say, okay, we will take returns only after the other investors are paid. So the other investors, the risk is somewhat mitigated, and that's what like roughly blended finance looks like. I haven't, to be honest, I haven't seen that take much traction in the India market yet. And again, I'm not top of it. My focus is more equities, so I might be wrong, but at least I haven't seen much of it hit in the headlines in the recent year or so. Um, Whether that will remain the case, I don't think so. I think at some point you'll see more and more kind of innovations happening in the field of, let's say, climate finance, or where blended finance will be definitely one of the approaches. But today it's not mainstream.
Okay. Thank you. There's one more question. Ishan, are you able to unmute yourself, or would you rather have us relay the question? Uh,
You can read something like this.
So, I think the question is, are there any examples of the bond types that you've mentioned from the Indian context? Any of these that are listed where a retail investor can actually invest, or is it mostly commercial with institutions involved?
Yeah, so typically what happens is either a corporate is issuing a green bond, right, directly to institutional investors, or on the other side, you have bankers raising these green bonds and then deploying it for a variety of projects. So there is, let's say, one company issuing a green bond, maybe for a set of their specific projects, or a bank says I'm going to raise $100 million, or let's say 100 crore rupees, and then I will deploy it maybe 50 different people in green projects. Um, I don't think there are like green bond India specific funds. I can double check that. But most of the corporate bond funds do have some exposure to green bonds. So typical bond fund that you invest in, which invest in corporate bonds, you will see some bit of green bond exposure. Thus far, I think historically, a lot of the individual like corporate green bond fundraising has been targeted towards the international investors, because those are the ones who are, I would say, much more aware about it and much more motivated to invest in these products. They have some mandates to invest X% of their AUM into certain green products, or whether it's bond or equities. So that's what you see typically, where Indian companies going overseas to raise green bonds for certain green projects. But I think it's just a matter of time. Now, your second question touches upon, I would say, a little bit more deeper aspect about sustainable finance products in the Indian market, right? Available for retail customers. So I'll go a little bit, take a little bit of leeway and talk about equities. So on the equities side, you have, I think most large asset managers have at least one ESG or sustainable fund. So the labels are slightly different, but you will have, most of the large asset managers have one fund out there, and these have been around for at least 3-4 years now. That could be one avenue you might want to explore if you're looking to like have sustainable investing. Um, but like, I'll be honest, I think that as an industry we need to do much more. I think we've had a decent start of 4 or 5 years back. And then we haven't really gone anywhere. So I think as an industry, we need to do more in terms of both having more products for the retail investors, but also spending some time to create awareness, which I think we haven't done enough of as an industry.
Thank you. Thanks for that. I think we do not have more questions in the chat right now. Would you want to continue, Hardik, with the presentation?
Sure. Like, so my slides are done now. Just like two title slides that I have. So I'm going to just talk. There's no more content to show per se. So I think there was interest in learning about like what is a typical day in the life of a sustainable investment professional. So I can talk from my experience, and I'll maybe go a little bit deeper to give you context of what all types of roles I've played in my career. I started off back in 2010 in Ernst & Young in Mumbai, basically doing climate change advisory. So we were doing a variety of carbon credit projects. We were doing carbon footprint assessments and so on and so forth. And from there, in 2013 is when I shifted to what is now known as ESG research, ESG investing. I did stints with MSCI in India. Then I moved to Singapore with Sustainalytics, doing ESG ratings. And then since 2017, I've been on the asset management side, where uh, I basically helped set up processes to do ESG research, analysis, and then integration into a variety of funds across equities and fixed income asset classes. So that's like in a short summary of my career trajectory. So my perspective, what I'm going to give you today is from a person who is basically as a part of an investment team in an asset manager, and helping them analyze and quantify environmental, social governance risk from a perspective of ESG integration. So in that particular role, what your day-to-day job looks like is a few things, right? So I think one of the most important tasks that you would have is create what we know as an ESG assessment framework, right? Whether it is your own proprietary framework, or whether you kind of rely on third-party rating agencies like MSCI, CRISIL, and others. Um, the idea is to essentially find a set of factors that you think are relevant for a particular sector. So let's say for a cement company, under environmental emissions or environmental pillar, I'm going to look at carbon emissions, I'm going to look at biodiversity impact, and probably I'm going to look at let's say sulfur and nitrous oxide emissions, whatever. Like, I'm just giving some examples, but these are the three things I think matter the most. On the social side, I think I'm going to look at health and safety and community relations. On the governance side, I'm going to look at board independence. I'm going to look at auditor independence, and so on and so forth. So you create a framework. You have an assessment of companies within your investable universe, and this need not be companies that you already own in the portfolio. Obviously, that's the priority, but at times what portfolio managers do is, let's say we have a universe of 500 names. I'm going to at any point of time only own 200 or 300 of these, but I could kind of churn the portfolio, right? I could sell something else, buy something else. So that's the most common kind of job description you'll see is what is known as an ESG analyst, looking at corporate sustainability disclosures, whether it's BRSR, whether it's sustainability report, integrated report, assessing a company's sustainability practices as per your framework. And then, depending on how the outcome is, let's say you have a score, for example, on a scale of 10, um, you find the company X having basically scored poorly on either environmental pillar or on an overall basis, that will drive your engagement efforts as well, right? So what I will then do is, hey, company X, I've done your ESG assessment based on your public disclosures. And according to us, these are a couple of areas where your performance is lacking peers or your performance is not as expected by us. What are you doing to change that, right? So that kind of a I'll say that that's the cycle. So you do assessment, you identify the risks, factor those risks in, and then in some cases use engagement. In other cases, you think the risk is just too high, so maybe you just don't buy that particular stock. That might be different levels of outcomes. In addition to this, as some of the peers, and this is now more specific to Indian markets, but some of the peers, including ourselves, have an international book of business, meaning foreign investors invest in Indian kind of funds. For those clients, they have expectation of a periodic what is known as ESG due diligence, meaning they will ask a set of questions to us saying, okay, hey, I've invested in your mid cap fund. Uh, can you tell me what are your ESG approaches? How many companies have you engaged with in the last 12 months? What were some of the case studies? What do you do in case the company doesn't respond? Do you just sell the stock? Do you have some sort of escalation? So those kind of variety of questions they would ask us, and then we are expected to kind of respond to them on a periodic basis. These are also becoming more and more common in some of the new request for proposals or RFPs as well. So you have basically a reporting angle. Client reporting is what I just talked about, and then you have either regulatory reporting. Uh, for instance, SEBI for ESG label funds had certain monthly disclosures that they require these funds to put on their website. So that's one part of your job. And then there are a lot of the asset managers who perform or who practice rather sustainable and responsible investing are signatories to an organization called as the PRI, the Principles for Responsible Investment. So on an annual basis, you are also expected to report to PRI the progress you've made over the last 12 months with regards to your responsible investment and engagement and stewardship practices. So there's the reporting angle, there is an analysis and investment angle, and then there's engagement as well. So these are like typically the common kind of let's say activities that an ESG analyst or a sustainable investment analyst does from an asset management lens. I'll just pause here to see if you have any questions before we kind of go into the next part, which is about careers and skill development.
Disha, do you see any hands raised? I do not yet. If not, we can move to the next section.
Hey Sabul, so I don't see any hands raised right now. I think
Yeah,
we can go forward. Yeah.
yeah. I think we can go forward, Hardik. Yeah, sounds good.
Sure. So in this, and I'll probably overlap a little bit with what Jocelyn said and maybe what you'll hear from the other speakers as well. But I'll just give you a big picture of what are different careers in the sustainability space, right? Not just climate investing. I think broad sustainability and climate is sort of a subset of that. Uh, the way I see it, I would kind of classify this into so three broad buckets, right? One is consulting, and Jocelyn talked about it a bit earlier. One is finance, let's say broadly, so in banking and investments. And the third is corporate roles, right? So on the consulting side, obviously you have a wide variety of consultant in the market who are advising both corporates as well as investors, whether it is sustainability reporting, whether it's assurance, uh, whether it is carbon footprint assessments, whether it is strategy development for your broad ESG, whether it's doing materiality assessments. There's a ton of things that people do, and you have everyone from, let's say, an individual who's consulting to the big fours like the EYs and Deloittes of the world. In this space, very active. This is, I would say, of the three, the most vibrant and the most let's say from a job perspective, the most attractive space in the Indian market, where you will see a ton of jobs coming even today and then in for the foreseeable future. So that's kind of the consulting side. On the corporate side, which is the other spectrum, you basically have corporate sustainability teams, right? So it could be a two-member team for a small corporate, it could be a 20-member team at a large conglomerate. But their role essentially is to identify KPIs that they should be monitoring and reporting on, whether it's as per a client request, whether it's as per certain MSCI ratings or sustainability ratings, or whether it is as per certain reporting standards like the TCFD or the GRI. They essentially, their job is to liaise with the internal different departments to set up monitoring and reporting of certain metrics, and then come out with sustainability reports or an integrated report, depending on the case, on a periodic basis. So that's kind of again a field that has been operational in the country for at least 20 years, if not more. So that's a fairly mature space. The so-called less mature spaces on the financial side, where I think only in the last 5 to 7 years you've seen both banks and asset managers starting to kind of add sustainability specialists within their teams. Now here on the bank side, you essentially have two types of roles that exist. One is on the credit risk assessment side. So when you are either assessing credit risk for a particular new loan or a new project, you would factor in a variety of environmental and social risks. And I think in more specifically, the RBI has been focusing on climate risk in the recent years as kind of something that the bank should focus more and more on. So then as a part of your credit risk assessment, you do climate risk, the scenario analysis that we talked about earlier, those kind of things, and then come up with a decision whether you want to kind of lend to a particular project or a particular company or not. On the other side is more on the fundraising side. So we talked about green bonds or sustainable bonds, and then you are basically on the fundraising side and you are devising, let's say, instruments that are sustainability themed, right, for your essentially eventual clients to invest in. So that's the second part on the banking side. On the asset management side, I think largely what I spoke about in the previous section is the type of role you will see on the asset management side. One kind of less common role, but I think should become more and more common in the future, would be that of a ESG kind of knowledgeable financial or a fundamental analyst, right? So today you have an equity research analyst or a bond analyst who's separate, and then you have people who are like myself, who are more environmental social governance specialists, right? These two are separate roles, but as time progresses, you will start seeing these two converging. So either you are a financial analyst and you kind of uh, improve your knowledge and understanding of how to kind of assess environmental social risks and then kind of upskill there, or you are an ESG analyst or a sustainability analyst by nature, but you kind of upskill yourself to understand how financial analysis works and then kind of merge these two. So that's how I see this field, especially in the asset management space, evolving. It has already happened in the foreign markets. I can talk about Singapore and Southeast Asia because that's a market I have lived and worked in for a long time. Uh, in that space, I think now most of the new roles coming up in the asset management space are more often I need a pharma analyst, but I also need ESG as a skill set for the pharma analyst, rather than I need a separate ESG analyst and I need a separate pharma analyst, right? So the field is already converging, and same goes for portfolio management as well. So like this is a short summary of like different careers that are there in this space. I'll just pause here to see if you have any questions on this last section that I spoke about.
Checking if we have any hands raised, or if not, people can unmute themselves if you'd like to ask a question, or just drop it in the chat if you're not able to unmute right now. I think some of the points, Hardik, that you mentioned were really interesting also about the maturity of the market. In the meantime, I think while people are sort of warming up and, figuring out what specifics they'd like to ask, could you tell us a bit more on maybe what you've seen, the type of certifications that people are taking up, or something that they're doing along the way to upskill so that they can do better and they have a better shot at getting roles like this?
Right. Yeah, so I think if you talk about the investment space, the CFA Institute has, I think, now two or three certifications in place. The most popular one is the certificate in ESG investing. I think now they've renamed it recently to certificate in sustainable investing because of the ESG backlash in the US. But largely, that's the most popular one that I have seen people take. The other ones that I would kind of, in a way, recommend considering would be there is something called as the GARP certification. So this is Global Association of Risk Professionals. They have a sustainability and climate risk certificate. All of these are basically self-study and then kind of at the end of it, give an exam and pass it and get a certificate kind of a structure. That's another one which is popular. And then more recently, you've seen, I think, I think more specifically, the CFA Institute come out with something called as a certificate in climate investing. So that's very specific to climate investing. So they have stuff like how do you assess climate risk in equities and bonds and those kind of things. So if you are looking to build a career in the asset management space, I think the ESG investing certificate as well as the climate investing one is definitely something I would recommend looking at. Uh, I think from the other corporate sustainability side, I think historically, and this has been around for 15, 20 years now, you have consultants and others offering some sort of a GRI certification, or now I think you'll see more of the ISSB S1, S2 kind of certification programs where they will walk you through the framework and what does this indicator mean, that indicator mean. So on the corporate sustainability side, that would definitely be handy. One other way, and this is what I have done, right? So I don't have any formal education on sustainability or ESG. I've just basically spent bulk of my career in this space, so I've learned on the job more or less. What I've essentially found very valuable. So if you're kind of aiming to get into the technical side of things, right? So I want to be a more someone who can do carbon accounting. I want to be someone who can do maybe guide companies on how to do more energy efficient business operation and so on and so forth. So I think consulting space is a good one. You might want to join one of the big fours or maybe one of the environmental consultants like ERM, for example, because on the job you'll learn a lot more in the consulting space than elsewhere. And then if your goal is to basically eventually get into asset management, then my recommendation would be maybe start off with ESG ratings or ESG analysis role with one of the rating agencies, right? You have in India now, I think MSCI, ISS, Sustainalytics, all of these have big operations, I think mostly out of Mumbai. And you could join these, maybe pick up a sector or two, learn more about what are the material factors, how do you assess them, read more and more sustainability reports, and then kind of eventually evolve into and let's say mature into the asset management space. So that could be one other kind of approach to do.
Thank you. Thanks so much, Hardik. I think we have one more question that's in the chat. Ishita, would you want to unmute?
I think he answered it a bit when he answered the question about CFA Institute. But my question was, what kind of skills or technical skills do we need to become a ESG analyst specifically?
Sure. So for good or bad, it's not rocket science. I think you just need to understand certain terminologies. You just need to uh, develop a skill set of how do I link environmental or social issues to financial risks. So, my recommendation, let's say when I started in this space, it was very, very specialized domain. A handful of people were doing it. So there was more and more need for ESG or sustainability specialists. But like I said earlier, going forward, my recommendation to anybody kind of starting a career in this space today is don't just be someone who knows about ESG or sustainability. You need to understand finance as well and then be able to kind of merge the two, right? So uh, either if you've done your BCom or let's say masters in finance, that could be some like basic level of knowledge of how valuations work, how you do discounted cash flow analysis. I think these kind of things will help. Uh, yeah. So how do you then translate that? So let's say a company is having higher carbon emissions versus peers. India is going to have a carbon tax regime soon. this is my estimate of how much it's going to be per ton of carbon. This is how it's going to impact its expenses and eventually profitability. So to be able to make that connection, sometimes it's going to be easy, like the example I gave, and other times you'll have to kind of make certain assumptions. But ability to do that is what's going to define your, like if today I'm going to hire someone in my team, I need someone who understands investing in valuations, not just purely sustainability. I mean, that's how I would look at it.
Thank you, Hardik. I think we have time for one last question. Rashmi has her hand raised. Rashmi, would you want to go ahead?
Yes, thank you. Hardik, I've been working in the NGO space since 1 year, and I've often felt because during my placements also and my 2 year post graduation, I was always into getting all these certifications, and I came across CSC and all those things as well. And now, when I'm working since 1 year, I have always felt that though at the social part, we as a sector we are very advanced, but these technical aspects, especially the financial ones, and as well as these maybe the more corporate like technical things, those are often missing. And because sometimes we don't have these inter dialogue between these two sectors, so somehow we are lagging behind, or now we are not being able to make that kind of impact which requires in our social work sector, because maybe because we are more isolated, and
Mhm.
I don't know how to even integrate. And as a person, I want to remain in this sector, social sector, but I don't know how these certifications can be integrated, or even how to make a case for these developing skills in these aspects to my organization or in the sector itself. So, do you see any
Yeah.
scope for it, or how do I even begin?
Well, so I think I mean, the fact is that the not-for-profit sector is different for versus for-profit, right? The goals are very different. So if you're talking about the not-for-profit sector, I really doubt ever going to be a convergence of the two. There's like I think one of the slides I was showing earlier, basically what people are saying is I have some sort of a goal, a social impact that I want to create, and I'm going to donate some sort of a grant or a charity, whatever it is. There, the goal is very clear. Where you can get in investors or bankers more interested in social development aspects, let's say affordable housing, let's say women empowerment of some form, let's say women promoting enterprises that are, let's say, led by women and those kind of things. Where you, in those aspects, you need to bring in the financial angle here, right? Just because somebody is doing great job and let's say treating poor for free, why should a for-profit business kind of invest in that business? And there has to be some return. Yes, and there's a positive impact, and nobody denies that. But these guys have, in addition to that, a motive basically generate returns. So I think where these two will merge is what is known as sustainable investing or impact investing, for that matter, where there are dual goals. There's a financial goal and there is also a sort of a social or an environmental impact goal. That pool of capital which wants to do that is very small but growing, right? So that's the target you want to attract, where you say, okay, are there any private equity or a venture capital impact investors in space? In the public space, it's a little difficult to do impact investing, to be honest, but uh, there are already existing private equities in India, either Indian or foreign, who have offices in India doing this already. So I think those are the target markets you might want to explore more in detail. But the mainstream investors will not essentially get into these kind of impact, say have very limited exposure rather to that space.
Thank you.
Thank you so much, Hardik. I think with that, we'll be closing the session, but we just wanted to take a minute to take a group photo and just say
Yes.
a moment of thanks, Hardik, for taking out time on a Saturday. It's been a really busy month, I'm sure, with the end of the financial year and everything that's going on. So thank you so much from all of us for coming and sharing such like wealth of information with all of us. Thank you.
Thanks. I hope it was useful. Again, happy to chat more in detail on LinkedIn or anything. If there's questions I haven't been able to answer, but wish you all good luck.
Thank you.